Welcome to This Explainer. All right, right now we are witnessing what is arguably the single most expensive technological arms race in corporate history. We're going to unpack the historic scale of big tech's latest investments into artificial intelligence and, honestly, dive into the absolute mystery of Wall Street's surprisingly nervous reaction to the whole thing. Grab your notebooks because the numbers we're looking at today are literally reality-bending.
Let's start with the big one, 118 trillion yen. To put that into perspective, that translates to roughly 750 billion US dollars. And listen, this isn't a company valuation, it's not total revenue. This staggering figure is just the combined 2024 capital expenditure forecast for exactly 5 companies: Amazon, Alphabet, Microsoft, Meta, and Tesla. It's an absolute tsunami of cash, dedicated almost entirely to building the physical foundation of our AI future. But here's where it gets interesting. Why on earth is Wall Street punishing them for spending it? This brings us to a massive contradiction, right? These tech giants are opening their wallets like never before to build a very future everyone agrees is inevitable, yet the market is incredibly anxious. In fact, investors are actively punishing several of these companies. So, to understand why Wall Street is sweating while Silicon Valley is spending, we really need to look closer at the data.
Let's dive right into Section 1, the 118 trillion yen bet, a historic financial commitment.
The expected $750 billion total across these 5 tech titans, it's not just a slight bump to keep up with inflation. No, it is more than double what they spent in the previous year. They are essentially doubling down on their infrastructure in a single 12-month window. It's a pace of expansion that is, frankly, almost hard to comprehend.
Moving right along to Section 2, the massive CapEx breakdown. Who is spending what?
So who's writing the biggest checks? Well, Amazon is leading the pack. Their $200 billion forecast isn't just a massive number. It's actually the highest single-year capital expenditure by any U.S. company in the last decade. Just let that sink in. Right behind them, we've got Microsoft projecting around $190 billion, which, by the way, is nearly triple their figure from last year, and Alphabet is bumping their guidance up to somewhere between $180 and $190 billion.
You're probably wondering, where on earth does all that money actually go? Well, these billions are fueling a massive physical infrastructure build-out. We're talking about aggressively prioritizing those highly specialized and incredibly expensive NVIDIA AI chips. They're buying up vast server farms, expanding data centers all over the globe, and funneling billions into physical robotics. It's the whole shebang.
And it's not just the traditional cloud computing giants getting in on this. Even Tesla, who isn't really a traditional hyperscaler, bumped its budget up to $25 billion. What's absolutely wild here is that this was a $5 billion increase over guidance they had just set 3 months prior. Elon Musk is pointing that money straight toward AI infrastructure, building a massive research facility for chips, and seriously ramping up production of their Optimus humanoid robot. Everyone is basically sprinting to stay in this fierce AI infrastructure race.
Which brings us to Section 3, the Wall Street paradox. Beating expectations, dropping stocks.
Now this is where things get really weird. Across the board, these massive hyperscalers reported first-quarter earnings that totally beat Wall Street estimates on crucial metrics like revenue and growth. I mean, they did their jobs, right? They exceeded revenue expectations. Yet 3 of the 4 major hyperscalers saw their stock prices drop immediately following their announcements. Amazon dipped 2%, Microsoft fell 5%, and Meta plunged a staggering 10% right after they announced they were increasing their spending guidance by $10 billion.
But there was one lone exception to this total bloodbath, and that was Alphabet. They actually saw a 7% stock bump. So why them? Well, because they were able to reward the market with tangible, immediate proof that their spending was actually working. They pointed to a seriously impressive 63% year-over-year increase in their Google Cloud earnings. Basically, they showed the receipts, and Wall Street loved it.
Let's move to Section 4, the infrastructure bottleneck, why they must spend.
Alphabet's CEO Sundar Pichai directly addressed this tension we're seeing. He plainly told analysts, "We are compute constrained." And it's a remarkably simple explanation for a multi-billion-dollar problem. Their growth isn't being held back by a lack of ideas or a lack of customers. It's actually currently limited by the sheer lack of physical computing power needed to run these incredibly complex AI models.
Alphabet CFO Anna Ashkenazi backed this up perfectly. She noted that this unprecedented demand for AI compute has created a very real and very lucrative bottleneck.
To justify their massive spending increase, she revealed a totally staggering $460 billion backlog of contracted, unfulfilled cloud deals. Think about that. The business is literally right there, waiting at the door.
All of this is creating a culture of immense FOMO, fear of missing out, and severe scarcity. Because the demand for AI capabilities is vastly outpacing the speed at which these companies can actually pour concrete and build servers, clients are literally putting themselves on wait lists just to rent data center space. And the specialized hardware to run them, primarily those NVIDIA chips, well, they remain in chronic short supply. Honestly, no company wants to be the one that loses a major client simply because they ran out of server room.
And that leads us to our final section, the client risk factor, the house of cards. I like to call this the OpenAI factor. See, these massive hyperscalers aren't just building AI for themselves, they're renting this unprecedented computing power out. The entire ecosystem rests on the massive assumption that AI startups, like OpenAI, are going to successfully monetize their products fast enough to cover their soaring cloud infrastructure costs. It's a bit like a house of cards. If the clients can't pay the rent, the landlords are going to be in massive trouble.
And this brilliantly illustrates just how fragile the market is right now. When the Wall Street Journal reported that OpenAI had missed some internal revenue and user targets, it triggered an immediate, massive domino effect. It literally dragged down the entire AI supply chain. Oracle, who holds a massive server contract with OpenAI, dropped 7.7%. Cloud provider CoreWeave fell 7.4%. SoftBank dropped 10%. Even the chip makers, from NVIDIA to ARM, saw drops between 2 and 6%. Just from one missed target.
Now, you might be wondering, okay, well, why didn't Amazon, Microsoft, and Alphabet crater as hard as their suppliers during that panic? Well, they possess what we can call the hyperscaler shield. They're partially insulated from this massive sell-off because they don't just rely on one or two hot AI startups. They have a highly diversified global client base, and perhaps more importantly, they have their own wildly lucrative in-house consumer products to fall back on.
So that brings us to the ultimate question we all have to ask as this arms race continues to accelerate. The money is being spent, the servers are being built, but can AI revenues eventually justify this historic $750 billion bill? Wall Street remains incredibly nervous because the answer to that question is still unwritten. What do you guys think? Are we looking at the dawn of a new industrial revolution, or is this the most expensive tech bubble in history? Thank you so much for joining me on this explainer. I absolutely cannot wait to see how this all plays out.